Games Workshop, which I had a look at this time. This stock is down. It's down 0.67% this week, but in the context of a week where the FTSE 100 is up 3 or so, Games Workshop actually fell 3-ish% on its earnings update. I wasn't super sure why. I'm capable of reading things that they say are positive and things that they say are negative, but I read B&M's thing last week where they said it was all positive, and I disagreed. I'm not quite sure what the market didn't like about this, but I saw what people were putting it down to, and I think I sort of get it. So revenues came in 21% higher. Their licensing revenue, which is obviously a smaller part of their business when you look at the overall thing, came in 149% higher. Earnings per share were up 33% to £2.89. The kind of negatives, at least the overt negatives on this, were that they flagged cost inflation from suppliers as a potential issue. They don't anticipate inflation in their own operations, but they do buy in materials. They may well see materials going up, and they were flagging that for investors on the way through. They don't think the increases to the national living wage or minimum wage are going to make any direct difference to them because they already pay above those things. But again, if suppliers have to increase their staffing costs, they will probably try and pass those through the way that companies all seem to in this kind of way. They also noted there's a decent amount of uncertainty over tariffs because it feels like every UK company currently has to mention that, especially if they get a lot of their revenues from America. They're right to say that, and I think they're right to describe that as uncertain. They have said they will work out how to deal with that when they have more detail on it, which I think is probably fair at this point. It would be disingenuous to say it's nothing going to happen. They can't know that. It would be sensationalist to say it's all going to be a disaster. Right now, stocks are around 25 times earnings, which, to be honest, is where I think it probably ought to be, having gone nowhere. It was starting to push higher into earnings and get up to around 30-odd%. And I think at that point, things start getting a little bit stretched, even for what I think is a very good business and offers some very good unit economics and metrics here. So you got about 1.16, I calculated, percent coming back as a dividend. So 4 and a bit% in the year, which is about what you expect because they don't tend to have huge amounts of cash lying around the place. They tend to bring it in and get it out. So 25 times earnings is 4% earnings yield, about 4% dividend. At the current kind of run rate, that's roughly in line with what I would expect. I thought it was slightly ahead on the way into earnings, and it's probably checked back now to roughly where I think it ought to be, Steve.
Yeah, and there was a lot of things in this report to celebrate, Steve. I think Kevin Roundtree, the chief executive, was pretty honest. He said that they'd struggled to keep enough stock of some products on the shelves, and this has led to them looking at opening a fourth UK factory. They're looking somewhere around Easter Park. I think it's going to open probably in the back half of this year. That's a lot of this growth has obviously been driven by the sort of excitement in this Amazon TV series that's coming up, but also another thing to celebrate is the Space Marines 40k game. 6 million unique players now. It's not been on any of the game passes where you can pay a subscription to play new games and the PlayStation version where they give them away for free or what have you. So it's pretty fair to say 6 million people, there or thereabouts, Steve, have actually gone out and bought this game, which is pretty impressive for them. It's a nice thing for them to have. So yeah, plenty to celebrate in this report, Steve, I thought. And yeah, plenty of obvious things ahead that could continue to boost sales. I think if this Amazon TV show ends up being a success, Steve, then there could be years and years and years of growth ahead for Games Workshop at a good clip.
That could be a smart move for both sides. To be honest, I can see Amazon getting some decent content from that as well, and I'm interested in how long that's taken and how careful Games Workshop are being with their basically their intellectual property, right? Because I agree, this is kind of thing that I think if it's handled right, and everything about this tells me it's being handled right, even though I'm not a Warhammer aficionado or enthusiast, this could work out well for both sides. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.